Good morning. This is Travis Bement with YourOrlandoMortgage.com, and this is my economic commentary for the week of August 17th, 2009. More about less. Competition. The big news last week was the closing of Taylor Bean & Whitaker and the possible effect it would have on mortgage lending across the country. Taylor Bean & Whitaker was the 11th largest lender in the nation and the 3rd largest lender for FHA mortgages. The fear was that would continue and reduce the supply for available mortgages and limited choices for borrowers. While that is still the fear, last week's failure of Colonial Bank will probably make a bad situation even worse. The issue: warehouse lending. Large banks such as SunTrust, Wells Fargo, and Bank of America have large sums of money available to them to loan to customers for mortgages. When they later sell these loans, they replenish their supply and are able to do it over and over again. For small lenders like community banks, mortgage bankers, and others, they rely in many cases on warehouse lines of credit. A small bank or a mortgage banker, like the mortgage firm where I work, obtains a line of credit from a larger institution. They use this money to fund new loans and then replace the capital when the loan is sold on the secondary market. In the past, up to 50 or to 60% of new loan business went through these channels. Many of the larger players in this market, such as National City, Washington Mutual, Banco Popular, Credit Suisse, and UBS, have left the warehouse lending business. In 2007, there was approximately $200 billion in warehouse lending. Now, there is only $25 billion, with almost 25% of that controlled by Colonial Bank. Since the purchaser of Colonial Bank, BB&T Branch Banking and Trust, is not expected to continue in that market, the loss will be felt by everyone. Projections show that mortgage closings this year will amount to about $2.8 trillion, and there will be a $630 billion funding gap due to the loss of warehouse loans. That loss in supply will mean less competition and higher costs for the lenders that are left. Those costs will be passed along to the consumer in the form of higher rates and loan fees. In short, more options means more choice and lower costs for consumers. Rates were a pleasant surprise last week. The 30-year fix fell about 0.375 or 0.38% in just 1 week. Investors on Wall Street are hedging their bets on a quick turnaround. Those fears have helped push bonds in the right direction to help mortgage rates. Once again, this is Travis Bement with YourOrlandoMortgage.com, and we'll see you next week. Thanks.